How to actually build a trust fund, 5 assets that make a trust powerful. Most people hear the words trust fund and picture inherited wealth reserved for the ultra-rich. But here's what that image misses entirely. A trust is just a legal structure. What makes it powerful, what actually turns it into a wealth-building engine for your family, is what you put inside it. A trust by itself does nothing. An empty trust is like an empty bank account. It exists, but it doesn't work for you. The families who build lasting financial legacies understand that a trust becomes a trust fund only when it's funded with the right assets. Assets that generate liquidity, monthly income, long-term growth, or all three. Today we're going to walk through the 5 most effective ways to fund a trust, how each one works, and why each one matters in 2026. Number 1, life insurance. Instant liquidity when it matters most. Let's start with life insurance because this is often the simplest and most immediate way to put meaningful capital inside a trust structure. Here's how it works. The trust is named as the beneficiary, or in some cases the owner, of a life insurance policy. When the insured person passes away, the death benefit flows directly into the trust, and the trustee then distributes those funds according to your specific instructions. Why does this matter so much? Because death is unpredictable, and without liquidity, even wealthy families can find themselves in a bind. Without this kind of planning, heirs may need to sell real estate, liquidate investment portfolios at unfavorable times, or break up family businesses just to raise funds to cover taxes. A life insurance policy inside a trust solves that problem immediately. Your family doesn't have to sell anything. The cash is simply there. The death benefit is excluded from your taxable estate. Assets in the trust are protected from creditors, and you maintain control over exactly how and when your beneficiaries receive the funds. One important caveat in 2026. If you transfer an existing policy into an ILIT, the 3-year look-back rule applies. The cleaner approach is to have the trust purchase a new policy directly. That way, the 3-year rule never applies. Number 2, rental real estate, building monthly cash flow inside your trust. If life insurance provides a one-time payout at death, rental real estate does the opposite. It generates ongoing income month after month. The typical setup looks like this. Rental properties are held through an LLC, and that LLC is then owned by the trust. The LLC layer provides liability protection, and the trust layer ensures that when you pass, the properties transfer seamlessly to your heirs without going through probate. Rental income in a revocable trust is generally reported on the grantor's personal tax return. Depreciation also continues under the trust. The big picture advantage here is simple. Instead of leaving your family a single lump sum, you're leaving them a machine that keeps producing income. Number 3, real estate sale proceeds, turning equity into flexible capital. Now, not all real estate is meant to be held forever. Sometimes the smarter play is to sell, and when that happens, a trust can be the vehicle that captures and redeploys those proceeds. When a property is sold and the proceeds flow into a trust, the trustee now controls a pool of flexible capital that can be reinvested into new properties or placed into a business. One particularly effective tool for doing this is a Grantor Retained Annuity Trust, or GRAT. This allows excess appreciation to pass to heirs with zero gift tax impact. Number 4, brokerage accounts. Long-term compounding within a protected structure. Taxable brokerage accounts can be transferred directly into a trust by retitling the account. You're simply changing the name on the account from your personal name to your name as trustee. Once inside the trust, dividends, interest, and capital gains continue to accumulate. The trust manages their distribution according to your instructions. One of the most common and costly mistakes families make is creating a trust but never properly funding it, leaving assets stuck in probate anyway because the paperwork was never completed. Number 5, business income, the most scalable way to fund a trust. The 5th and arguably most powerful way to fund a trust is through business income. This is where estate planning intersects directly with entrepreneurship. When a business is owned through a holding company, and that holding company is owned by a trust, the income the business generates can flow into the trust. This structure is particularly valuable because businesses can scale. A well-run business can compound earnings in ways that passive assets simply cannot match. There's also a succession planning dimension here. The transition of ownership is governed by the trust documents, not by probate court or family disagreements. your legacy. Here's the core idea behind everything we've covered today. A trust is a structure, and like any structure, it's only as valuable as what's built inside it. So if you have a trust, ask yourself honestly, what's actually in it? Are your accounts retitled? Is your real estate properly held? Have your business interests been formally assigned? Together, they don't just create a trust, they create a trust fund, one built to protect, grow, and transfer your wealth on your terms across generations.